Hey everyone, welcome back to Corporate Decoder. Today we are diving deep into Moatable Incorporated's latest financial report, a quarterly filing with a twist that might make your eyebrows raise. Get ready because this report might just tell a story of shifting strategies, a big buyback, and a company possibly waving goodbye to full-blown public scrutiny. So, the big news first, Moatable Incorporated filed their quarterly report for the period ending the 30th of September 2025. This document gives us a snapshot of how the company is doing financially. Let us take a super quick look at their balance sheet. As of the 30th of September 2025, Moatable had total assets of about $70.4 billion. On the other side of the ledger, their total liabilities were around $38.1 billion. This means the shareholders' equity, which is what the owners really have a claim on, was about $32.3 billion. This looks pretty solid at first glance, showing the company has more assets than liabilities, which is always a good sign. Now, let us talk about how they are making money, or in this case, losing it. For the 3 months ending the 30th of September 2025, their total revenues were $20.4 million. That is an increase from the $16.7 million they brought in for the same period in 2024. Seems like demand for their services is growing, but here is the kicker. That revenue growth did not translate into profits. In the third quarter of 2025, they actually reported a net loss of about $1.5 million, a big change from the modest profit of $1.2 million they had in the same quarter of 2024. Looking at the bigger picture for the first 9 months of the year, their revenues went up from $46 million in 2024 to $57.7 million in 2025. That is a healthy climb, however, their net loss also grew. For the first 9 months of 2025, they lost $2.2 million, which is a bit better than the $2.5 million loss they had in the same period of 2024, but still a loss. And when we look at their operating expenses, they are spending more money to make that money. For the third quarter of 2025, their operating expenses went up to $16.6 million from $13.2 million in the same period of 2024. This increase in spending combined with the revenue growth led to a bigger operating loss, going from $571,000 in 2024 to $1.5 million in 2025. The 9-month loss from operations narrowed though from $2.8 million in 2024 to $2.0 million in 2025. Now, what is really interesting is what they did with their own shares. On the 3rd of September 2025, Moatable started a tender offer to buy back a lot of its own stock. They planned to buy back up to 225 million shares. By the end of September, they had successfully bought back over 85 million shares for about $5.7 million. This is a significant buyback representing over 10% of their total shares. Companies usually do this when they think their stock is undervalued or to return cash to shareholders. Interestingly, a good chunk of this buyback was funded by a new loan. On the 11th of September 2025, they took out close to $10 million from PNC Bank. This loan is secured and has a decent interest rate, but the fact they are borrowing to buy back shares suggests they are actively managing their capital structure, maybe to boost shareholder value or to prepare for something else. But here is the real bombshell. Moatable is planning to suspend its reporting obligations under the Securities Exchange Act of 1934. This means they will stop filing regular reports like the 10Q and 10K. With the sexy, why would they do this? Well, it is usually because their number of shareholders has dropped below a certain threshold, and they no longer feel the need for the full compliance burden. This could signal a shift towards being a more privately held company, or at least a less transparent one. It also means less information will be available to investors going forward, which can make it harder to track the company and potentially affect their stock price. Now, about their internal controls. The report states management concluded that their disclosure controls and procedures were not effective. They identified 3 material weaknesses. First, a lack of a systematic process to assess financial reporting risks, especially for complex deals. Second, a mistake in calculating sales tax accruals on their software revenue. And third, a general weakness in ensuring internal controls are actually working and in place correctly. To fix this, they are hiring more people with accounting expertise, bringing in external consultants for complex areas, implementing a new accounting system, and improving approval processes. They are also working on their sales tax compliance. While it is good they are addressing these issues, the presence of material weaknesses is a red flag that suggests past financial reporting might have had some accuracy issues. Looking at their segments, Lofty, their real estate business, saw its subscription revenue go up slightly in the third quarter, but paid subscriptions actually decreased by 5%. However, purchased seats, which I think means active users on paid subscriptions, did increase. This is a bit of a mixed signal. Revenue is up, but fewer are directly subscribing. Trucker Path, meanwhile, is seeing more subscribers, up 26% year over year for subscriptions. Their advertising revenue also saw a healthy increase. This segment seems to be performing more strongly than Lofty in terms of subscriber growth. Overall, Moatable's total revenues are climbing, which is positive. The increase from $16.7 million to $20.4 million in the third quarter is a solid jump. But this revenue growth is costly. Their cost of revenues also jumped significantly, leading to a dip in their gross profit margin. Their expenses are also on the rise across the board. Selling and marketing expenses went up by about 10%, research and development by almost 40%, and general and administrative by nearly 30%. This ramp up in spending, especially in R&D, is likely to develop new features and products, which is good for long-term growth, but it is hitting their bottom line in the short term. The big takeaway here is that growth comes at a cost, and for Moatable, that cost is currently outweighing the revenue gains, leading to losses. The shift from a profit in the third quarter of 2024 to a loss in the same quarter of 2025 is a significant development. Now, talking about the company's direction, Moatable is clearly pushing hard on its SaaS businesses. Lofty and Trucker Path, the growth in revenue is there, but the profitability is not. The substantial share buyback, funded partly by debt, alongside the plan to suspend public reporting, suggests a company that is consolidating its position, possibly to focus on internal growth away from the immediate pressures of public markets. The material weaknesses in internal controls are a concern and indicate that while they are growing, their financial reporting infrastructure needs significant strengthening. The risks for Moatable seem to be centered around executing their growth strategy profitably, managing their increased expenses, and the potential challenges that come with reduced public transparency. However, the growing revenue from their SaaS platforms, particularly Trucker Path subscriber growth, shows promise. The question is whether they can turn that revenue into sustainable profits without increasing costs too much. So, what is my take? Moatable is in a growth phase that is currently burning cash. The win with the tender offer and loan shows they can manage their capital, but the suspension of reporting obligations is a big signal that makes them harder to follow. It is a calculated move, but one that investors should pay close attention to. Alright, that is our deep dive into Moatable's latest report. What do you think about their strategy and the upcoming shift away from public reporting? Let me know in the comments below. If you found this breakdown useful, please give it a thumbs up and subscribe for more corporate insights. And don't forget to join our Discord community. The link is always in the description. Thanks for watching, and I will see you on the next episode of Corporate Decoder.